Hello, friends. Welcome to this April edition of Monthly Viewpoints. Lately, geopolitical events, spike in commodity prices, rising inflation, and hawkish Fed commentary have taken center stage, and that has given way to higher market volatility. We have seen the much anticipated correction in equity markets globally, including in India, although it has been followed by a partial recovery. The environment of higher inflation and slower growth is negative for risk assets in the short term. However, past episodes of crisis reflect that such events had little discernible impact on markets on a medium-term basis. In terms of the impact on India's economic growth, given that the duration and the impact of geopolitical conflict is highly unpredictable, we can see downside risk to India's growth forecast for FY23. Today, the RBI downgraded India's FY23 GDP growth rate forecast to 7.2% from the earlier 7.8%. However, over the next 3 years, India is likely to go back to its real GDP growth trend of 6.5%, with all the three drivers of the economy, namely consumption, investment, and exports, firing. The rural economy should also pick up given the higher crop prices, and manufacturing in India should also benefit from the China Plus One strategy, given the continuing COVID crisis in China. Today, the RBI also increased its FY23 inflation forecast and raised the reverse repo rate by 40 basis points. At the same time, it has continued to maintain an accommodative stance and kept the repo rate unchanged. In terms of the macro backdrop, India remains on a stronger footing this time compared to earlier episodes of a spike in crude oil prices. The current account deficit, fiscal deficit, and inflation are expected to be manageable. India has strong forex reserves of more than $600 billion, which should enable us to tide over the current period without any difficulty. If you look at earnings expectations, in the near term, higher commodity prices may lead to lower consumer discretionary demand and lower corporate margins, resulting in a downgrade in earnings for FY23. However, we believe that over the next 3 years, Nifty earnings are likely to grow at a 13 to 15% CAGR, which is higher than the long-term average. Valuations have corrected but remain close to the long-term average. The heightened geopolitical conflict has also led to elevated FII outflows from India, but the same has been offset by strong DII buying during this period, which is supporting the markets. On a medium-term basis, we continue to remain positive on Indian equities and expect markets to continue to scale higher. A long-term narrative for India remains intact. Overall, we believe Indian equity markets can give returns slightly below the earnings CAGR over the next 3 years. In terms of sectors, the banking sector is slated to do well given the bump up in credit growth versus the earlier COVID levels, healthy capital ratios, continuous improvement in the trajectory on both gross NPAs and net NPAs, and the strong provision coverage ratio. Overall, we maintain our recommendation that investors should stay invested, continue the SIPs, and aggressively increase equity exposure in case of any correction. We provide a basket of funds for investors to choose from. Thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। स्कीम संबंधी सभी दस्तावेजों को ध्यान से पढ़ें।